This chart shows the price of everyday commodities like oil, wheat, and copper over the last 2 centuries. If you measure these resources in dollars, the line goes up forever. Life simply looks like it gets more expensive. But inflation is really just the measuring stick, the dollar, shrinking in value. Watch what happens to this exact same chart when the measuring stick changes. When you measure those identical commodities against physical gold, they actually get cheaper by nearly 1% a year for 200 years. The physical world becomes more affordable, as long as you hold the right asset. For 2 centuries, the dollar survived its steady decline because the economy consistently added more human beings to the engine. More taxpayers, more borrowers, more consumers. Artificial intelligence breaks that math. It grows the economy and corporate profits without growing the need for human workers to pay into the tax base. We are watching trillions of dollars flood into a single AI trade in the stock market. Yet the most successful investors on Earth are sitting out. Warren Buffett is currently hoarding $400 billion in cash, the highest level of his entire career. At the exact same time, global central banks are quietly altering their balance sheets. For the first time in modern history, they moved gold above U.S. Treasury bonds as their #1 reserve asset. Retail investors are buying into an AI-driven stock market high, while the people who actually manage the global financial system are running to physical, finite assets. The current market boom provides the perfect exit liquidity for central planners to secure their wealth before the debt system fractures. To understand why central banks are hoarding physical metal, you have to look at how Western financial institutions managed gold for decades. When you bought gold through a bank, you typically bought what is called unallocated gold. You weren't buying a specific bar in a vault, you were buying a digital promise. This diagram shows the scale of that illusion in the London market by 2021. There were roughly $635 billion in paper gold promises, resting on top of only $70 billion of actual physical gold available to back them up. That is $9 of claims for every $1 of real metal. Banks created an unlimited paper supply of something that only exists in limited physical supply. This kept the true price of gold artificially suppressed. The entire mechanism worked under a single assumption: no one would ever ask for all the physical gold at once. That bluff was called in 2021. The Bank of International Settlements instituted a rule change known as Basel III. It forced Western banks to fund their gold positions with real money, making the paper shell game far too expensive and risky to maintain. Foreign nations saw the vulnerability. China spent years quietly buying the gold that Western institutions sold at those artificially suppressed prices. In a single recent year, China imported 939 tons of physical gold, more than a quarter of all the gold mined on Earth. Western central banks have been leasing their reserves into the market, and that metal flowed east into private hands and sovereign vaults. Now, paper gold trading has collapsed to its lowest level in 13 years, while physical market demand takes over completely. The East is actively draining the actual physical supply. They are stripping away the paper illusion and moving their real wealth out of dollar-denominated debt. The United States government runs a massive deficit, and for decades, foreign central banks reliably recycled their trade surpluses by buying U.S. Treasury bonds. With countries like China stopping those purchases, the U.S. desperately needs a new, massive buyer to fund its debt. The solution is a piece of legislation called the Clarity Act, which structures the legal framework for payment stablecoins. A stablecoin is a digital currency pegged directly to the dollar, and crucially, backed entirely by U.S. Treasury debt. This flowchart shows how the Clarity Act rebuilds the financial system on digital rails. It allows major corporations to issue their own digital dollars. When a consumer uses a corporate stablecoin to buy groceries, the underlying capital routes directly into holding U.S. Treasuries. The corporation acts as a mini central bank. The government no longer has to convince a foreign nation to buy its bonds. Every consumer on the planet who downloads an app and uses a digital dollar for a transaction automatically, indirectly funds the U.S. government. Traditional banking executives, like J.P. Morgan's Jamie Dimon, are fighting this transition. If a corporate digital wallet pays a 4% yield backed by treasuries, consumers have absolutely zero incentive to leave their deposits in a traditional bank paying less than 1%. Meanwhile, crypto executives are spending hundreds of millions of dollars lobbying for the act. They want the legal framework finalized so they can build this global yield-bearing infrastructure. The stablecoin framework is the dollar's survival plan. It is a fully privatized system engineered to force global demand for U.S. debt by embedding it directly into the digital rails of every smartphone transaction on Earth. We are watching a direct collision. The United States is building an inescapable digital dollar net, while the BRICS nations are securing finite, physical gold to route completely around it. This scale visualizes a mathematical solution to this standoff. China runs a $1.2 trillion trade surplus with the world. If the price of gold is allowed to rise to roughly $39,000 an ounce, the total value of China's recent gold imports exactly equals that massive surplus. Letting an asset reprice solves the imbalance. Chinese consumers holding highly valued gold gain massive purchasing power to buy the world's goods. The US dollar weakens in turn, which lowers export costs and allows American manufacturing to actually compete globally again. The alternative to repricing an asset is trying to settle a $1 trillion trade imbalance by force. If the financial pressure doesn't release through the markets, history shows it releases through a global physical war. The massive valuations in today's tech sector exist to extract capital from the current system before the math breaks entirely. Trillions are being spent to prop up an illusion of endless growth, while the real assets move out the back door. The race between Eastern gold and Western digital stablecoins will decide how global trade operates for the next century. Whichever system wins, the purchasing power of the money in your pocket will be dictated by the outcome.